Japan, a country with just 2% of the global population, could shake the entire world economy. Sounds like an exaggeration, right? But what if is not? Recently, Japan released its first quarter growth numbers, and they weren't great. In fact, the economy is taking a step backward.
Auto industry announced disappointing numbers for the last quarter of the business year, and they're warning of rough waters ahead. Toyota, Honda, and Nissan all saw their profits decline in the 3 months ended in March. For their outlooks, all cite the negative impact from the auto tariffs imposed by the Trump administration.
Rice prices remain stubbornly high, and the average Japanese family is feeling the squeeze. The government tried to fix it, but with limited success. Now you might be thinking, why should I care? I don't live in Japan, and that is a fair question to ask. Japan isn't usually splashed across headlines like the US or China. But here's the thing. Japan's economic choices can ripple across the entire globe. They could affect interest rates in your country, shake global stock markets, and even trigger the next recession. But why? Well, because Japan isn't just another economy. It's one of the world's largest creditors. They hold over $1 trillion in US government debt. And for decades, Japan has been quietly fueling some of the world's riskiest financial bets, all through something called the yen carry trade. Yen, Japan's currency, is actually one of the most important in global finance, and it's getting stronger. And that sounds good on the surface. But is it? We got a taste of why in 2024. The carry trade started to unwind, the yen spiked, Japanese stocks crashed, and global markets, including the US and Bitcoin, took a hit. At the time, analysts at JP Morgan warned this was just the beginning.
Japanese bonds are usually seen as safe, so why is demand low? Well, three main reasons. First, the Bank of Japan, the biggest buyer of JGBs, has been tapering. In other words, slowly reducing their bond buying program since last year. So there's a vacuum left there. Secondly, the second biggest buyers, Japanese life insurers, pension funds who usually love long-term bonds, well, they haven't stepped in. They're worried about rising yields, looking for shorter durations and better returns elsewhere. And thirdly, Japan's debt levels are massive. Now, we are talking about 200% of GDP. That's almost double that of the US, which currently sits at 124%.
Now, let's talk about something that doesn't get nearly enough attention. Demographics. Basically, who's working, who's spending, and who's retiring. Japan happens to have the oldest population in the world. Around 30% of its people are over 65. Their birth rate has been below replacement for decades, and the population has been shrinking since 2008. By 2050, Japan is expected to lose 20 million people. That's like the entire population of Chile or the Netherlands. Why does that matter? Well, because fewer workers mean slower growth and less tax income. More retirees mean higher spending on pensions and health care. To keep things afloat, the government borrows more. That's why Japan has the highest debt-to-GDP ratio in the developed world. They've managed this for years by keeping interest rates at rock bottom and having their central bank, the Bank of Japan, buy up a huge chunk of their own bonds. But even then, Japanese investors looked overseas for returns. That's how they became the biggest foreign holder of US treasuries. But here's the issue. That entire balance is breaking. The Bank of Japan is stepping back. Interest rates are creeping up. And the huge mountain of debt Japan's been sitting on. It's starting to matter, and a lot. For decades, Japan was the world's financial backbone. It was the biggest creditor nation, holding over $3 trillion in net foreign assets. That money didn't just sit in bonds. Japanese investors bought US stocks, corporate bonds, and real estate. That capital helped keep US interest rates low and supported global asset prices. So how did Japan have all that money to send overseas? Well, because their interest rates were basically zero, and that made the yen carry trade a global moneymaker. Here's how it worked. Borrow cheap yen, convert it into higher-yielding currencies like dollars or euros, then invest the money in U.S. stocks, real estate, crypto, whatever offered a decent return. The profit came from the difference in interest rates. In 2023, U.S. rates were over 5%. Japan's, still negative. That gap made the trade a gold mine. Bloomberg estimated the yen carry trade reached hundreds of billions of dollars globally. But there's always a catch. It only works if Japan keeps rates low and the yen stays weak. If either changes, the whole thing collapses. And that's what started in 2024. The Bank of Japan raised rates. The yen surged 10% in just weeks. Japanese stocks tumbled, and US stocks followed. Bitcoin dropped, and big institutions started pulling the plug. By 2025, the situation has only intensified. The Bank of Japan is still tightening, bond yields are rising, and the yen is climbing. That means trillions of dollars in global bets could unwind. One margin, call it a time. Japan might even start selling US treasuries. That would be huge. They've long been a key buyer. Losing that support could drive up borrowing costs in the US and rattle bond markets worldwide. In May 2025, Japan's 30 and 40-year bond yields hit record highs. Investors now demand bigger returns just to hold what used to be considered the safest assets in Japan. And why? Because confidence is fading. Bond auctions are failing. The central bank can't prop up everything forever. And that leads to some really tough questions. How long can Japan keep this up? What happens when an economy built on cheap money can't afford to raise rates? This brings us to companies like Metaplanet, a Japanese firm that owns a ton of Bitcoin. Its stock skyrocketed recently as investors looked for a hedge against Japan's crumbling bond market. They're not betting on Bitcoin to replace the yen. They're betting that some value needs to sit outside the system, away from central banks and manipulated markets. And here's the bigger picture. While Japan's financial foundation shakes, Bitcoin quietly hits an all-time high. Not many people noticed. Google searches are still low, but the trend is telling. People are starting to ask, what happens when governments can't grow out of their debt? When raising taxes isn't enough? When cutting spending is political suicide? The answer increasingly seems to be, inflate the debt away, devalue the currency, hope no one panics. And that's what people mean when they say, nothing stops this train. It keeps rolling until it can't. That's why many are adding more Bitcoin to their portfolios. Not because they're all in, but because it's one of the few assets that sits outside this fragile system. Stocks still have value, and people are continuing to invest there too. But having a hedge, a little insurance, makes sense. Because the story of Japan, it's not just Japan's story. It could be a preview of what's coming for the rest of the world.